A big part of the disinflation story, a big part of the market story right now is that the market has done a lot of the heavy lifting for the Fed and its fight to tighten financial conditions.
Well, the market has, with the real yield, the real 10-year TIPS yield has gone up quite a bit. I remember, when the Fed first started this process of raising rates back in the spring of 22, we were about 1.3% negative real rates. So you were getting a negative real return for 10 years. Therefore, even an infinite PE ratio looked attractive relative to that. Now it's a different story. You're pushing 2.5%, and therefore the market did a lot of the work for the Fed.
When we talk about, I guess, what comes next, or more importantly, I guess, Barry, what investors want to come next or what they're planning to come next here, is the idea that have folks gotten comfortable enough with the idea of higher rates and that those higher rates are basically here to stay, at least for the foreseeable future?
Well, debt's only unsustainable when the rate is above the nominal growth of the economy. So R minus G is the concept. We're not there. The nominal GDP of the United States and the interest rate on the Treasury average curve is pretty much in line. So we're okay there. I do think that the 10-year yield is peaking here. It has peaked, actually, just under 5. I look at where the 10-year TIPS should be, the real yield relative to what's called R star, the neutral rate, or the potential GDP of the United States with other adjustments. I look at the break-even 10-year inflation. At $88 oil, it should be around 2.5. So 2.5 plus 2 plus or minus a half a point. You're at 4.5 plus or minus a half a point. We're there. So the 10-year yield is peaking. And the damage to the PE ratios, the correction, the double-digit correction in that third quarter, I think it's over.